Welcome to the deep dive. Today we're really zeroing in on Organon Co. That's ticker OGN.
Right. Global healthcare company. Big focus on women's health, but they also have biosimilars and those established older brands.
Exactly. They spun out from Merck back in June 2021, and their whole mission, or what they state anyway, is tackling unmet medical needs, especially for women. They've got over 60 medicines and products in their lineup.
Yeah, and what's really grabbing attention now is the kind of crossroads Organon seems to be at. We've pulled together research to look closely at their latest financials, specifically Q1 2025.
In the stock performance, too, which has been, well, pretty rough.
Definitely rough. And that huge dividend cut they announced right after the Q1 numbers, that really made headlines.
Yeah.
Plus, we need to look at the CEO, Kevin Ali, buying stock recently. So the goal here is to try and figure out, what's the story behind all these numbers and moves? What might it mean for where Organon is headed?
Absolutely. And for you, the learner, we know you want to get your head around complex stuff like this quickly and without getting buried in detail. So we've done the digging, earnings reports, analyst notes, the whole 9 yards to pull out what really matters.
Trying to find those key insights, those aha moments without the overload?
Exactly. Okay, let's get into it. Let's unpack that recent financial performance first. Q1 2025.
Okay, so first quarter 2025, Organon reported revenue of $1.513 billion.
Okay.
Now, that's actually down 7% compared to last year as they reported it.
Right.
If you strip out the foreign exchange effects, it's down about 4%.
Right, the XFX number. Always good to look at that for the underlying picture.
Exactly. And this drop, well, it was actually pretty much what the company expected. It's mainly driven by something called loss of exclusivity, or LOE.
Yes, LOE. That's when patents expire, right? And generics flood in, a constant challenge in pharma.
Oh, precisely. But it wasn't all doom and gloom in Q1. The women's health part of the business actually did quite well.
Oh, really? Okay, tell us about that.
Yeah, that was a definite bright spot. Revenue there was up 10% as reported, even better XFX, 12% growth, hit $463 million.
Wow, okay. What drove that?
A big piece was Nexplanon. That's their contraceptive implant. It saw really strong growth, 14% XFX.
Nexplanon seems like a real anchor for them.
It really does. And also, Fulstum AQ, that's a fertility drug, it had a good quarter, partly because of a favorable comparison, basically. An old operating agreement ended, making this year look better.
Got it. So next one on strong, Fulstum looking good on the comparison, but I remember seeing Nuvaring in the report too, and that didn't look so hot.
No, definitely not. Nuvaring revenue took a massive hit, down 41% XFX.
Oof, that's steep. Generic competition again.
Directly because of it. Ties right back to that loss of exclusivity we mentioned. So even within women's health, you see these really different stories playing out. Growth here, sharp decline there.
Makes sense. Market dynamics really hitting hard. What about the other segments, biosimilars and established brands? How did they look in Q1?
Right, biosimilars. Revenue there was down 17% as reported. 15% XFX landed at $141 million.
Why the drop there?
A few things going on. Ontruzant sales volumes in Brazil kind of normalized, came back down to earth. Renflex's saw a 17% XFX decline, mainly due to pricing pressure in the U.S.
Pricing pressure is always tough in biosimilars, isn't it?
It really is. And the timing of some international tenders also played a part. Those big government contracts, winning or losing those, or just the timing can swing quarterly numbers.
Yeah.
But there was a bit of an offset from Hadlima. That's their Humira biosimilar they launched in the U.S. last July. It's starting to ramp up.
Okay, so some challenges, but Hadlima providing a bit of cushion. And established brands, that's the older stuff, right?
Correct. Lots of mature, off and off patent drugs there.
Yeah.
Revenue decreased 11% as reported, or 8% XFX, down to $887 million.
And the newer products they've brought in, like Emgality and Vtama, not enough to fill the gap.
Not yet, it seems. They just couldn't fully make up for the hit from Atozet losing exclusivity in Europe. And Singulair sales were lower too, especially in China and Japan.
So it really highlights that contrast, women's health growing, but biosimilars and established brands facing some pretty serious headwinds.
Absolutely. It shows how much they still rely on some of those older drugs and how critical it is for the newer portfolio items to really start contributing more and faster.
Okay, that covers the top line, the revenue picture. Let's talk bottom line. How did all this affect their profits?
Yeah, profitability definitely felt the squeeze in Q1. Their gross margin slipped, both as reported and adjusted.
Okay.
And net income, well, it plummeted, down 57% to just $87 million. That's only 0.33 cents per share.
Wow, 57%? That's a huge drop.
It is. Adjusted net income was down 2, though not quite as sharply, decreased 16% to $265 million, or 1.02 per share.
And EBITDA, that's a metric a lot of people watch.
Right, adjusted EBITDA, that fell 10% to $484 million, and that meant the margin compressed down to 32.0%.
So even if they're controlling costs, those LOEs and the pricing pressures are really eating into the profits.
That's the story. Precisely. And it leads us to the balance sheet. You see $547 million in cash. But against that, almost $9 billion in debt. $8.96 billion, to be exact.
Whoa, that puts their net leverage.
Around 4.3 times EBITDA, that's quite high. It's just a pretty significant debt load relative to their earnings, which definitely increases financial risk.
Yeah, no kidding. But despite all that pressure, they kept their full-year guidance.
They did. They reaffirmed the 2025 outlook, still guiding for revenue between $6.125 and $6.325 billion, and that adjusted EBITDA margin between 31 and 32%.
Huh. And they're still aiming for decent free cash flow.
Over $900 million before one-time costs. That's the target. It does make you wonder, after such a tough Q1, what gives them confidence for the rest of the year? Are things expected to turn around dramatically?
That's the big question, isn't it? So that's Q1. How does it stack up against the full picture for last year, 2024? Was it building towards this?
Looking at 2024 overall, the picture was a bit brighter, at least on the surface. Revenue actually grew 2% as reported, 3% ex-FX, reaching $6.403 billion.
Okay, so growth last year, what was driving that?
Again, women's health was key, up 4%, or 5% ex-FX. Nexplanos was strong, and also the JADA system.
Right.
Biosimilars also had a good year, up 12%, both reported and ex-FX. That was largely driven by that U.S. launch of Adlima.
And established brands, they were down in Q1 25.
In 2024, they were actually flat overall, maybe up 2% ex-FX. Those newer additions, Emgality and Vkama, were doing their job offsetting some earlier LOE impacts then.
So 2024 had some positive signs, especially on the revenue front. But those Q1 2025 challenges, the Atozet, LOE, Nuvaring getting hit by generics, the biosimilar pricing those clouds were already gathering, weren't they?
Absolutely. Even with that revenue growth in 2024, you could see these headwinds forming for 2025. And now we're seeing them hit.
And profitability in 2024, was it already showing strain?
It was. Gross profit was decent, $3.7 billion, about a 58% margin. But net income actually fell 16% compared to the year before, down to $864 million. Interesting.
So revenue up, net income down.
Yeah. Adjusted net income was roughly flat, and adjusted EBITDA was $1.958 billion, a 30.6% margin. So even in 2024, you could see some pressure building on the bottom line despite the top-line growth.
Okay, let's circle back to that debt figure you mentioned, nearly $9 billion. That feels like a really central part of the Organon story right now.
It absolutely is. $8.96 billion as of the end of March 2025. Net debt was around $8.2 billion at the end of 2024. It's a significant burden.
Yeah.
And when you compare total liabilities to their liquid assets, it's quite a gap. Those leverage metrics we talked about, debt to EBITDA, around 4.6x, interest coverage below 3x at year-end 2024, they really spell out the financial constraints.
Which logically leads us to the dividend, that huge cut, over 90%. That's drastic.
It's incredibly drastic, going from $0.28 per share quarterly down to just 2 cents. $0.02.
Wow. And the reason is purely debt reduction.
That's the stated reason. They need to free up cash. This move redirects about $200 million that would have gone to dividends this year, redirects it towards paying down debt.
And they have a target for that.
Yeah. The goal is to get net leverage below 4.0 times by the end of 2025. It just shows how serious that debt situation is. They're prioritizing fixing the balance sheet over everything else, including shareholder returns right now.
A major shift in strategy. And the CEO, Kevin Ali, was pretty upfront about this, right?
He was. He basically said they needed to proactively support the balance sheet, framed it as crucial for stability and ultimately for investor confidence.
Although, as you hinted, the immediate reaction from investors wasn't exactly confident.
No, not at all. The market reaction was swift and brutal. Which brings us to the stock performance.
Yeah, let's talk about that. It's been a wild ride, mostly downwards.
Volatile is putting it mildly. The stock's just been hammered. That 52-week range you mentioned, $23.10 down to $8.05. That tells a story.
And the dividend cut announcement really triggered a fall.
Oh, yeah. May 1st, the day of the Q1 results and the cut. The stock dropped more than 28% in one day.
Ouch. Where was it trading after that?
By early May, it was hovering really close to that 52-week low, somewhere between, say, $8.70 and $9.50. Just clinging on.
From a technical perspective, that's just bad news, right?
Absolutely.
Yeah.
Clearly in a downtrend, trading way below key moving averages, the 50-day and 200-day. It just screams a crisis of confidence among investors.
And that dividend cut seems like the main catalyst for this latest leg down. Like the market suddenly thought things were worse than expected.
It certainly seems that way. It signaled a major problem, or at least a major shift in priorities that spooked the market.
And it's such a change because before this, Organon was actually a pretty reliable dividend payer, wasn't it, since the spinoff?
Yes, very consistent. They'd paid $0.28 every quarter like clockwork since 2021. That was $1.12 a year.
Which gave it a pretty high yield before the cut, I imagine.
It did. At times, the yield was up over 8.5%, which is very attractive for income investors, and the payout ratio seemed sustainable.
So cutting that essentially eliminates that whole aspect of the investment case. That high yield is gone.
Completely gone. The forward yield now is less than 1%. It fundamentally changes why someone might invest in Organon. It's a forced pivot to defense, to fixing the balance sheet above all else, dividend annihilation, really.
And when you have a stock drop like that, 28% in a day, and a dividend cut that drastic, it often leads to legal scrutiny, doesn't it?
It certainly does. We're already seeing multiple law firms announcing investigations into Organon and its leadership.
What are they looking into?
Basically, whether the company might have made false or misleading statements, or maybe failed to disclose important information about its financial health, especially regarding whether that dividend was sustainable, before they suddenly cut it.
And that huge stock drop on May 1st is the key trigger for these probes.
Exactly. That's the damage investors are pointing to. So now, on top of everything else, Organon has this legal cloud hanging over them. Potential lawsuits, future costs, uncertainty. It's another layer of risk.
Okay, so summarizing the situation. Financial pressure, stock price cratering, dividends slashed, potential lawsuits. The valuation must be reflecting all this pain.
Oh, it definitely is. Organon's valuation right now is squarely in distressed territory.
How so?
Well, look at the multiples. They're trading at massive discounts to peers, to the market. Market cap was down around 2.25 led Senkel, maybe $2.3 billion in early May. It was over $3 billion not long ago.
And specific multiples, like price to sales.
Incredibly low, around 0.35 times sales. Compare that to, say, Jazz Pharmaceuticals at 1.5 times.
Wow.
Same story for price to EBIT, forward PE, which is like 2 or 3 times earnings of EBITDA, all significantly lower than peers.
So on paper, it looks dirt cheap. But you mentioned the term value trap earlier. Explain that a bit.
Right. That's the danger here. Statistically, it looks like a bargain. Zacks even gives it an A for value style. But these super low multiples often exist for a reason.
Meaning the market sees significant risks.
Exactly. The market is deeply concerned about the debt, the LOEs wiping out revenue, the dividend being gone, those lawsuits. There's skepticism about whether they can actually turn things around. So it looks cheap, but it could just be a trap, a stock that looks undervalued but keeps falling because the underlying business problems are too severe.
Got it. So what are the Wall Street analysts saying? Is there a consensus view, or are they all over the place?
It's definitely mixed. The general rating seems to be hold or neutral, but the price targets analysts have are just incredibly wide.
How wide?
You see targets as low as $10 and others over $30. The average works out somewhere in the $70 to maybe $20 range. But you also had Bank of America downgrade their target recently.
That's a huge spread. What does that tell you?
It suggests a couple of things. Either some analysts think the market has massively overreacted to the bad news, or their higher targets are based on a belief in a long-term recovery that really depends on Organon successfully paying down debt and getting growth back on track.
So, big disagreements on whether they can actually execute that turnaround.
Precisely. Different views on the pace of recovery, the impact of the lawsuits, and whether those growth drivers can really offset the losses fast enough.
It really does sound like a show-me story for investors. Wait and see if they can deliver. Now, amidst all this gloom, the CEO stepped in and bought stock. That was interesting timing.
Very interesting. Yeah, May 5th, just days after that disastrous Q1 report and stock plunge, CEO Kevin Ali bought 34,000 shares.
How much was that?
Around $8.80 a share, so just under $300,000. And the CFO bought shares, too, about $100,000 worth, right near the 52-week low.
Insider buying like that, especially after bad news, is usually seen as a positive signal, right? Management signaling confidence.
Generally, yes. It suggests leadership believes the stock is undervalued at these levels. It implies they see a path forward that the market isn't appreciating.
Did the CEO say anything about it?
Well, even before the purchase, on the earnings call, he talked about a dislocation in their stock price, basically saying the market was getting it wrong. So the purchase backs that up, puts his money where his mouth is, you could say.
But couldn't it also be seen, perhaps cynically, as an attempt to shore up confidence after the stock tanked, especially with those legal investigations starting?
That's always a possibility, sure. The optics are good for them.
Yeah.
But given the context, it's more often interpreted as a genuine belief in undervaluation. It's not a huge purchase relative to the company's size, but it's a personal investment at a low point.
So, symbolic value maybe? A public show of faith when morale might be low?
I think that's a big part of it. Signaling to employees, to remaining investors, that leadership believes in the plan. It's a counter-narrative to the overwhelming pessimism.
But it's not a guarantee the stock will bounce back soon.
No, absolutely not. Insider buys are typically viewed as long-term signals. They suggest management sees value over time, not necessarily next week or next month.
Okay. So putting it all together, let's look forward. What does Organon need to do to get out of this hole? What's the path ahead?
Well, it really boils down to three main things. Navigate these LOE cliffs, pay down that massive debt pile, and successfully grow those key areas, women's health and biosimilars.
Let's break those down. Growth drivers. You mentioned Nexplanon is doing well.
It's crucial. They expect it to be over $1 billion product this year, 2025. Huge market share globally. The Jada system for postpartum hemorrhage is also growing nicely.
And innovation in women's health.
They talk about focusing on endometriosis, PCOS, bacterial vaginosis, areas with unmet needs. That's the longer-term pipeline.
Okay. And biosimilars. You said that's seen as key for growth, too.
Definitely. Hadlima, the Humira biosimilar, is ramping up in the U.S. They just launched Tofidence, an Actemra biosimilar, in May 2024. And they hope to launch a Prolia Xgeva biosimilar, denosumab, late this year in the U.S.
So new launches are critical there. And in established brands. Anything to offset the Atozet decline.
That's where Vtama and Emgality come in. You have a $150 million target for Vtama this year. Those newer additions absolutely have to step up to fill the gap left by Atozet's LOE, which is like a $200 million headwind this year alone.
It really sounds like a race against time, doesn't it? Can the growth engines ramp up fast enough to offset the declining legacy product?
That is precisely the challenge. Their 2025 guidance, being basically flat revenue at the midpoint ex FX, tells you they expect the growth to just about match the decline this year. What happens after 2025 really depends on that biosimilar pipeline delivering.
Does this level of decline suggest maybe they were too slow diversifying away from those older drugs? Or is this just the normal brutal cycle of the pharma industry?
It's probably a bit of both. LOE is expected, but the current impact seems quite severe, highlighting maybe a past over-reliance on a few key blockbusters. It certainly underscores the urgency now.
And the competitive environment isn't getting any easier, I assume.
Not at all. In women's health, they're up against giants like Bayer, AbbVie. Nuvaring is fighting generics.
Right.
Biosimilars is hyper-competitive. Intense pricing pressure. Big players like Amgen, Pfizer, Novartis. It's often about winning those tenders.
And established brands.
Competing mainly against generic manufacturers, companies like Viatris. But those international sales still generate important cash flow, even if they're declining.
So, main challenges remain. LOE, pricing pressure, high debt, the lawsuits. Any others on the radar? Supply chain.
They mentioned supply chain and tariffs, but said the impact looked limited for 2025. Still, it's always a background risk in today's world.
This whole pivot, cutting the dividend, focusing entirely on deleveraging, feels like such a defining moment. What are the long-term implications of this new capital allocation strategy?
It's a fundamental reset. Painful now, obviously, for shareholders who like the dividend, but the goal is long-term health. Pay down debt, improve the balance sheet, gain financial flexibility.
Flexibility for what? More deals?
Potentially, yes. Future business development, maybe more tuck-in acquisitions like Vtama or Tofidence down the line, but they really need to get that debt down first. Deleveraging seems like step one before any major strategic moves.
So it's a test of execution now. Can they actually hit those deleveraging targets?
Yeah.
And will investors wait?
Exactly. It's about execution and patience.
But what about innovation? Especially in women's health, which they say is core. Could this intense focus on debt starve R&D?
That's a really important question. It's a potential risk. They talk a good game about the pipeline endometriosis, PCOS. But when cash is tight and debt is the priority, R&D, especially early-stage stuff, can get squeezed.
What are they guiding for R&D spending?
Upper single-digit percentage of revenue, which, might not be enough for really aggressive pipeline development on its own. They might need more partnerships or deals.
And finally, we can't ignore those investigations hanging over them.
Right. That's a major unknown. It creates uncertainty, distracts management, costs money, and could lead to settlements or judgments down the road.
Yeah.
Plus, reputational damage. These things can drag on for years.
Okay, so let's try and wrap this up. Organon is clearly navigating some very choppy waters. Financial headwinds, a huge strategic shift with the dividend cut, lots of uncertainty.
That sums it up pretty well. There are significant risks. The debt, the LOEs, the competition is fierce, execution risk on the turnaround plan, and those legal issues. It's a lot.
But on the other side, you have that potentially very cheap valuation and clear growth drivers in women's health and biosimilars if they can execute. Success seems to hinge on getting that debt down.
It really does. That seems paramount. The CEO stock purchase might offer a sliver of hope that leadership sees a path through.
So for an investor, it really comes down to risk appetite and time horizon, doesn't it? If you believe in the turnaround and have patience, maybe today's price looks attractive long term.
Possibly. But if you're more conservative, the high debt, the lack of a dividend now, the legal clouds, it all screams caution. Maybe a wait-and-see approach is more prudent.
So here's a final thought for you, the listener, to chew on. Organon's immediate focus is clearly on that balance sheet repair, the financial surgery. But long-term, their success probably depends just as much on their ability to innovate, particularly in women's health. It's this tricky balance, isn't it? Financial prudence now versus investing for future growth. What gives you more pause? The immediate, painful financial fix they're undertaking, or the uncertainty around whether they can truly deliver on long-term innovation in a really tough market?
A difficult balancing act indeed.
Thanks for taking this deep dive with us today.